Kenya eyes 541 billion shillings in bonds for SGR and JKIA after Adani pullout. Kenya is exploring issuing 541 billion shillings in government bonds to finance major infrastructure projects, namely, the expansion of the Standard Gauge Railway, SGR, and upgrades at Jomo Kenyatta International Airport, JKIA, in the wake of the Adani consortium's exit from previously planned projects. The Indian conglomerate Adani had been poised to partner with Kenya on significant infrastructure investments, including a long-term lease or development deal for JKIA and power transmission schemes. However, amid controversies and legal concerns internationally, the Kenyan government cancelled or suspended the Adani-Kenyan deals. With those partnerships effectively off the table, Kenya now needs alternative funding sources to carry forward its infrastructure agenda. The bond issuance is seen as a response to that funding gap. The proposed bond initiative. The 541 billion shillings bond is earmarked to support capital expenditures on the SGR network and enhancements at JKIA. The rationale is that the projects are critical for connectivity, rail and air, and will have multiplier effects on trade, logistics, and tourism. Challenges and risks. Issuing such large sovereign or infrastructure bonds has multiple risks and considerations. Debt sustainability. Kenya already carries significant public debt. Additional borrowing must be weighed against the country's capacity to service the debt without jeopardizing fiscal stability. Investor appetite and terms. The success of the bond sale will depend on how attractive the terms are, interest rates, maturity, guarantees. If risk perceptions are high, Kenya will have to offer higher yields, which increases long-term costs. Implementation and execution risks. Even with funding, delivering on large infrastructure programs, such as the expansion of SGR lines or JKIA upgrades, is complex. Delays, cost overruns, or mismanagement could undermine the benefits. Loss of private sector participation. The exit of Adani means Kenya now bears more of the burden alone. Public-private partnerships often help to bring technical expertise, risk-sharing, and efficiency. With those partnerships weakened, Kenya must ensure strong oversight and project management. Potential upsides. Still, if well-structured and executed, the bond-financed projects could yield significant returns. Improved freight and passenger capacity. Expanding SGR could enhance cargo movement across Kenya and to the region, reducing costs and transit times. Upgrades at JKIA could increase airport capacity, boosting international traffic and tourism. Catalyzing economic activity. Infrastructure investment often stimulates jobs, local supply chains, and ancillary industries, construction, services, logistics. Strategic autonomy. Relying less on external private investors like Adani allows Kenya greater control over design, timelines, and governance of its infrastructure.